Bloomberg Audio Studios.
Podcasts, radio, news.
On-session lows is also what we're seeing within the commodity market as well. Oil getting slammed. That is similar to what we saw back on August 5th. Joining us now for more is Jeff Currie, Chief Strategy Officer of Energy Pathways over at Carlyle. Jeff, it's such a pleasure. Thank you so much for staying up late for us. What does $70 WTI say to you about global growth?
It'll definitely stimulate it relative to 85, 90. But I think, yes, you're right. It did sell off based upon concerns around China. But the data disappointment was a PMI that was expected to be 49.5 and came out at 49.1. Does that justify the oil market being at a record short? Absolutely not. No, I'm not going to argue Chinese demand growth is robust in any shape or form. And yes, they have structural problems on the longer term outlook. But by all means, it's not a collapse that would justify the market being as short today as it was in the global financial crisis of '08. So you got to ask, what's going on here? It's something far deeper than a slowdown in China, because when you look at this market fundamentally, inventories are low. The forward curve today, even after the sell-off, is backwardated, and a very high level of backwardation, which is consistent with a very tight, fundamentally strong market. And then the third issue is concerns around OPEC bringing on supply. They're bringing on a small amount that is being completely compensated for by decreases out of Kazakhstan as well as Iraq. And given the credibility of OPEC recently, it's going to be important that credibility is maintained. So I think these fears need to be put in the context of what the physical market looks like, which is relatively robust.
I'm curious, Jeff. I mean, as everyone tries to read these economic tea leaves, obviously oil sends a signal, or at least they think it sends a signal. Also, people are trying to look for those signals coming out of copper, and we're seeing a lot of weakness there for a fifth straight session here. We're a far cry from those days when people were calling for 10,000 or even 15,000, as one person called it. Maybe we get there long term, but I wanted you to talk more about the near term as to exactly what's ailing that copper trade.
Well, I think you had two dynamics in China. One, you had a very weak property market, and when everybody was bullish on copper going back in May, the offsetting force was that strong green capex. So China was subsidizing and beefing up the green capex investment, EVs, solar panels, lithium batteries, and that strength was keeping strength in copper demand, offsetting the weakness in the property demand. What has happened since then? The U.S. as well as Europe have responded with tariffs on some of these EV goods, slowing down that engine of growth for China. And at the same time, the policy focused at propping up the property market has, not come through as strongly as many people have thought. And so that weakness in the property market is currently dominating. So what does that mean to copper prices? It still has a floor based upon that strong structural supply story, but it has a cap on the upside based upon that weakness in demand. I would say, 8,500 type on the bottom, 9,500 on the top, until we start to see the policy begin to create some strength in China. But I want to emphasize, China is not unraveling like a global financial crisis situation in any shape or form. You look at, WeChat Pay numbers, it shows consumption up about 1%. And yes, oil demand was a little bit weaker than what the economics would suggest, because you have trucks switching to LNG from diesel. But that's structural, that's priced in the market. So I want to emphasize, yes, it's weak, but it's nothing like the positioning.
So let's get to the positioning part. You had a really interesting note out last week, Jeff, that talked about how oil being used in essence as a carry trade. I'm going to pull a little quote from your piece. You say, with the rate cycle likely peaking given recent data, we will see that the borrowing cost for oil will be relatively more expensive. And then you go on to say, hold on, let me pull it up here, forcing an unwind like it did with the yen, which has likely caused fear short covering from both the financial and physical markets. basically you're saying, look, what you're seeing in the market is that oil has been used to buy other stuff. And when that unwinds, that's going to be a sharp spike up. What do you see that everyone else is missing?
You see this not only in oil, but some of the other more capital-intensive industries. Oil is more volatile than most of the other sectors, so it has an extra cost to holding it. We estimate that to hold oil with a risk-free return of 5.25%, which is where the money markets are paying you right now, you need a return in excess of 14.25%, call it 15%. A 15% price move at a $75 price level means somewhere around, $10 or $11 a barrel. And then, so your expectations have to be for a big upward move before you're going to own it. Now with the sell-off down to 73 on a Brent basis, the probability of seeing that upside is now much more likely. You're probably going to see investors pull money out of the money markets and put it back into oil. But when I talk about the borrowing costs in being short oil, essentially by drawing down your inventories to very low levels, you're leaving yourself very exposed to being short if something were to happen, like a demand surprise to the upside or some type of supply shock. Then the physical guys would have to come in, cover that short, which means increase the demand for the physical barrels. And then you look at the paper inventories, call it working capital of physical oil, working capital of financial oil. They're also short the financial oil. And so when we look at the market today, you have record shorts against really low inventories. That historically doesn't happen. The only explanation for that is people are taking money out of this market, taking working capital out of this market and putting it into higher returning endeavors. What? Now with the pullback, you're likely to see some of that money come back in. Yeah. You'll race back up. Part of the reason why we've seen the market go from, 73 up to like 92, back to 73, up to 92 is the investors got to be pretty comfortable they see a return in the oil market that's greater than what they can see elsewhere.
So what happens, Jeff, in a couple of weeks' time when the Fed, as most people presume, begins to cut rates? Does that change that trade?
Well, I think there's a orderly unwind and a disorderly unwind. The Fed cut is expected. If they were to be much greater or something like that, it's probably going to be a very orderly process as we move back to lower risk-free rates of return, or think about the cost of capital holding oil in the financial as well as the physical, where that's going to begin to unwind. Here's another point, too, is that the Fed is a global central bank with a local mandate, meaning its policy affects the world. In many of those places like China, Europe, Japan, they're very capital intensive. And as the U.S. lowers the rates and lowers that cost of capital for a lot of those capital intensive sectors around the world, there's going to be a lot more leverage in those parts of the world where you're going to see the uptick. And oil is in particular one of those industries that's very capital intensive and very global in nature. So you should start to see a stronger improvement in the oil market than you would see in other sectors.
You also write in your note, Jeff, how this circles back to the U.S. fiscal deficit. How does it do that?
Because when we think about the fiscal deficit at 7%, it's near, it's a record peacetime non-recessionary fiscal deficit. That means when the Fed had to raise rates to slow down growth, they had to raise it a lot higher because it was going against that 7% fiscal deficit. So the interest rates got too high for the rest of the world, particularly the oil industry, slowing it down. And you think about OPEC, it was responding to that weakness it was seeing globally because of those pressures. And again, when we think about as they lower rates, that leverage to the other part of the world will begin to increase and allow OPEC to be able to put those barrels on the market.
Interesting.
All right, Jeff, got to leave it there. Great to talk to you. Great to catch up. Jeff Currie, he's now the Chief Strategy Officer over at Energy Pathways at Carlyle.